Okay. Can everybody hear me okay? And
Yep.
see the screen?
Yep,
Okay,
very good.
okay, great. Um, for those that are new, we would definitely want to welcome you to our Central Florida Meetup group. And we've had these meetings for about 4 or 5 years now. So, and there's a few people that have been with us since the very beginning. I know Eric has been around. There are a few other people. So, but anyone new, we definitely want to welcome you. And today's presentation is going to be on the wheel strategy and the poor man covered call. But before I start, just want to let you know that everything we talk about here is just for education. We're not making any trade recommendations or anything like that. So, and if you guys have questions throughout the thing, please just speak up. We definitely want to answer and make this as interactive as possible. So the wheel strategy, there's a lot of people that trade the wheel strategy or some version of it, and it's an options trading strategy where you actually sell puts to collect premium, and if the stock price goes into your short put call, you will actually take assignment of the stock. And then once you take assignment of the stock, you would actually start selling calls as a covered call. So that's kind of and then once the calls get taken or the stock gets taken away, you start all over selling a new put on a new stock. So that's kind of the idea of the wheel. Starts with selling puts, you get the stock, you sell the covered calls, the stock gets taken away, and then you start all over again. So that's kind of why a lot of people refer to it as the wheel strategy. Um, and I just wanted to give you a quick example of a wheel strategy. And I chose the SPY, and I at the time that I did it, the SPY was at 412 even. And so if we went out and sold, we would sell a naked put, or in some cases a put spread, and collect a premium. So I went to the option chain and looked at the 528 expiration, and we would have sold the 405 put. And in this case, we would have collected $281 per contract. And then based on my system, the buying power reduction or the margin would have been $7,545. So if SPY finished above 405 next Friday, you would have made $281 or about a 3.7% return in 10 days. And your break even would be 402.19. And all that is the 405 strike less the 281 premium that you took out. But the key thing on this strategy is if the stock finishes below 405, you'll be assigned 100 shares at your short strike. And in this case, that was 405 per share. And then you would need to sell calls against it to kind of complete the wheel. And the only exception is if you're doing this on a cash settled index, this wouldn't work. So you probably this strategy probably doesn't work really well for SPX or NDX. And I'm going to admit a few more people. Okay, so, and in terms of the benefits of the wheel, one is, and this is a very popular strategy, so it generates a lot of income by selling puts that expire worthless. That's kind of the whole idea. You sell the put, it expires, you start over. And if you get a sign, then you sell the calls. But the whole strategy is really just to generate income by selling the puts. And the strategy, and I've done a lot of research on the wheel. There's probably 100 different versions of the wheel out there. So your strategy can really be modified based on your risk tolerance, your, just whatever your preference is, you can modify this strategy. So the basic stuff is going to apply to everything. You may just want to change, things to better fit your style. And if you're on a margin account, you definitely will benefit by, reduced buying power reduction. So, for example, on Apple was trading at 124.85 at some point today. And if you sold the 528 120 put, you would collect $79 credit. And my system was showing me that the buying power reduction was $2,013 instead of the entire $12,485. So your rate of return based on the buying power reduction would have been, in this case, 3.9% in 10 days, as long as the stock finished above 120 by the expiration date. Your rate of return, you still would have made the $79, but your buying power would have been a lot less if it was a cash secured put. So any questions so far on any of this?
I had a quick question. So I was bringing up the option chain. So 528, are you usually looking at 7 to 10 days to expiration? Is that where you kind of?
That's generally the way I do it. I like to sell the weekly calls, but I've seen cases where people just sell the monthlies. Yeah. But what I found is that you can, if you sell every week, you generate a lot more income over that month period of time.
Right.
So, but that's more of a personal preference than anything that any rule or anything.
Right. Okay.
Mm-hmm.
That buying power reduction can grow, can it?
It can. It can change. It can change based on the fluctuation of the stock, and I would assume the volatility.
So you typically have a couple of these going at a time if you're buying 10 days out?
I try to, I'll go over how I do them in a little bit, but yeah, I try to add about one to two of these every trading day. So I will have, as many at the end of a week, 10 open positions. But that's just me. I mean, you could do it, based on your trading account size, how much time you have to watch them. You can kind of structure it any way you want to.
Brian?
Yeah.
It says here the buying power reduction of 2,000. Would you want to set aside additional capital that you kind of put on self-reserve? And if so, do you calculate that into your rate of return?
Yeah, I mean, that's a great question, because one of my points later is that you can really lose a lot more than that $2,000. Because if the stock really moves against you, that buying power you could lose more than that. So yeah, what I would say is you generally want to have some reserve set up, and we can talk about how to calculate that. But you want to be able to have enough cash that you could take 100 shares at $124.85, at least on a good portion of the put spreads the puts that you sell. Great question, though. That's really that's really important, because what you don't want to do is just write a bunch of these things, assuming that none of them are ever going to get assigned, because that's how people can end up getting themselves into trouble. So that is kind of the benefits of the strategy. And then I just wanted to show you what the risks of this strategy are, because you hear a lot of advertisement about this strategy and how easy it is and how it's free money. So I just wanted to kind of emphasize the risk as much as the benefits. So you can definitely be assigned shares of the stock if the stock moves against you. So you got to be prepared for that. Like Lee said, you got to have enough in reserves that you can take the shares and you don't have to exit out at a loss. And then the second point is you can lose more than the margin amount or the buying power reduction. So that's just kind of to your benefit. If it's a cash secured put, you can't lose more than that because that's the entire amount. So that would be if the stock went to zero. There's also a chance that you could get an early assignment. So even though I said 5/28 was the expiration date, if it goes in the money, you could actually get assigned early. You could be assigned a day early, 2 days early. It just depends on when somebody wants to exercise their put. And then when you do take the stock, you are tying up your trading capital. So, say for example, that Apple trade, the stock dropped to $110 a share and you get assigned at 120. So you're already $10 underwater. And it may take you a long time to dig yourself out of that trade. So that's a risk involved in the trade. And this is really a bullish kind of market strategy. You wouldn't want to be putting this kind of a strategy on in a bear market because you will get a lot of assignments and you just have to really watch that you don't get more assignments than you have capital for. And then the last part is you really just don't believe the hype that this is a free money or a guaranteed weekly paycheck strategy. Just hear that a lot. And I know, Lee, you shared a video with me. We talked about kind of the horror stories of, writing too many contracts on really volatile stocks where, you just get inundated with shares underwater and it just takes forever to get out of them. So just want to make sure we gave equal time to the risks of the strategy more than just the benefits. So, any questions so far or at this point?
Maybe you're going to cover this later on, but you kind of touched on it. So do you look at volatility, before you enter one of these, or what kind of filters do you use when you're making that decision?
It is a great question. I mean, volatility, the higher the volatility, it's kind of a two-edged sword. The higher the volatility, the better credit you're going to get for your naked put or put spread. However, there's a reason there's an increased volatility. So my advice would be what you don't want is a stock that is super volatile, because then you're going to make sure, then you probably have a higher risk of being assigned the stock if it moves a lot. So I think, and then you want to have enough volatility that you get enough reward for your risk. So that answer your question, Patrick? Or whoever answered
I guess I was asking if you have, say, a rule of thumb for that.
I don't. What I generally do is I'm looking at the stock itself, the stock chart, and where the support level is, and if it's in a bullish pattern, where would I sell my put so that it's below that level, and and then as I'm looking at maybe 2 or 3 different comparisons, the volatility change will really be reflected in the credit that you get there.
Okay, that makes sense. Thank you.
Mm-hmm.
You ever use the expected move, Brian?
I do. That's one of the ways you could do that. So, say for example, that stock is at $120 and the expected move is 10. Well, you could sell that put spread below that, 110 level. So, and it's a good way if you're looking at, multiple candidates, which one gives you the most downside protection for the same amount of credit.
Thanks.
Okay. Anything else?
So there are no stocks purchased against this, right?
Right. At this point, when you start, you're just selling either a naked put or a put spread. So you're not taking the stock on at that particular point.
Brian, do you have any advice for market correlation when doing your wheels?
Yeah, I mean, that's you definitely want to make sure that you aren't overexposed into any one particular sector. And I know a lot of, when you talk to people, a lot of people, when they get in trouble, they were overexposed into a particular sector like technology. Usually everybody is overexposed in technology because they pay the greatest credit. So you want to make sure, you have some technology, but you also want to have financials, healthcare, all the different sectors. And one of the things that I try to do is I look to see, what sectors are kind of in favor, and then dig down in there and pick some stocks that, might be good wheel strategies, or even the ETF, the index ETF as well. So yeah, you want to make sure that you're not buying all financials or all technical. You want a big mixture of either. You also want to make sure that you're not selling these puts through an earnings event, because that can really move the price of the stock. Or even big events, like a lot of times companies will do presentations or new product releases and things like that. So you want to kind of avoid those. You want it to be as kind of with no news as possible. So when you are selling naked, sorry about that. When you are selling naked puts, you can decide how far or how close to the money you want to sell puts. So if somebody is a lot more risk tolerant, they may choose a higher delta, for example. But you could choose your strikes either based on a specific delta and say, I'm always going to sell the 15 delta or the 25 delta, whatever your kind of risk parameters are. Or like someone had asked earlier, you want to sell this strike somewhere beyond the expected move of the stock. So if the stock is going to move, say 10 points in this particular time frame, you want to sell something at least 10 points out of the money. And then you can also do it based on selling the strike either one or even two standard deviations away from where the stock is trading. So lots of different versions there. And what I would say is, if you're new to the wheel, you might want to test different ones and see which ones you're the most comfortable with. And then you can sell weeklies. You can sell monthlies. I prefer to sell weeklies, so I don't even hardly look at any stocks that don't offer weeklies. So I just eliminate them from my screening process. And then you can also sell this as a spread, and I'll kind of go into how I do that as well. So, but there are many strategies, many different ways that you can set up your wheel strategy. So kind of the process is, you want to first focus on the underlying stock or ETF. You want to make sure that you're doing your analysis more on that than the actual options. And then you should have at least a neutral thesis of the stock. Hopefully it's a bullish thesis, but you could say, I don't think this stock is going to go down over the next period of time. And then once you've kind of selected a stock or a number of stocks, then you would go to the option chain to really see which ones pay the most credit. And what you'll find is that you'll find a great stock, and then you'll look at the option chain and it just doesn't pay anything for that risk. So you'll find some stocks pay better credit than other stocks, partly due to IV. Sometimes they just pay a higher credit for the risk. So again, you can look at the option chain either using a predetermined delta, say you always are going to trade the 25 delta, or you could look at, where is the support level, and you could sell your puts below that support level. Or you could select a strike, beyond the expected move, or just use one or two standard deviations. So that's kind of the most common ways of doing it. Does anybody else look at it at a different way of doing that? So I covered almost all the options. Okay. Okay, and then what I do is I sell wide put spreads. So in the case of just comparing, what I generally do is if it's a high price stock, say over 250, I generally sell like a 20-point wide spread. And what I found is that you collect about 80 to 90% of the credit of a naked put, and you have a lot more of a defined risk trade. So just doing a quick comparison on the SPY. So if we went back to our example and sold that 405 put, we would collect $281. The buying power reduction is $7,500, and the max risk, if it was a cash secured put, would be $40,000. So that return on the buying power reduction would be about 3.7% return. So you'd make $281. What I do is I would go in and sell the 405, buy the 385. And in this case, I would have collected $2.13 or $213 per contract. My buying power reduction and max risk are the same, $17.87. And my return would be about 12%. Now I'm getting less income. I'm making, the difference between 281 and 213. But if this stock, say it's sold off 10%, my max loss would be 1787. So that's kind of one of the reasons that I like to sell them as put spreads. One, it ties up less capital, but in the event of a trade that goes badly against us, I have a max loss that I can always just exit the trade and take that loss. I don't want to do that, but sometimes that happens, and you can exit the trade that way. So, any questions there so far? That makes sense, everybody?
Yeah. How do you select the strikes?
Well, what I try to do, I look at the expected move of the stock, and then I try to go beyond there, and I want to at least be one standard deviation move away from that, where the stock is currently trading. You just want to use a strike that's far enough out of the money that you have a really high probability of it not being assigned. And if it does get assigned, you're really getting that stock at a great price. That's the other thing. You want to make, like, for example, if, the stock, the index is trading for, I'm not sure what it was, 415, I'm willing to take the stock at 405. You have to have that kind of mindset to say, if it drops to my short put level, I'm willing to take it at that level and sell calls against it. That's kind of the whole kind of thesis of the wheel strategy. Did I answer your question?
Yep. In fact, that was what I had in mind. In the event that there is an assignment, how do you essentially avoid that assignment? Thank you.
Yeah. I mean, kind of the whole idea of the strategy is, instead of getting stopped out or anything like that, the end result is that you're going to take the shares, and you're willing to sell covered calls against those shares until they get taken away again.
Hey, Brian, got a quick question. Do you
Yeah.
time this with a broader, above the 50-day and below the 50-day, 21-day, any type of larger EMA to show that you're in a bullish stance?
Yeah, I mean, I generally want the stock to be above the 50-day EMA and above the 200-day.
Sure.
And in a bullish path, in some kind of a steady trend. You don't want a stock that's kind of bounces up and down. Those are not the kind of stocks you want to be trading this strategy on.
Were
So
you doing this around the February 21st, 2020 transition?
Yeah, we actually did. And we took assignment on a lot of stock. We also got stopped out on a few. So that spread really helped, mitigate any major losses. And then we, definitely did a lot less volume of trades. So even this last 2 weeks, I've done a lot less new trades just because the market has been a little bit more skittish. So as the market tends to get either bearish or just, unnerving, then I would probably not do this strategy. Or even go, further out. Say, you traded the 20 delta in a kind of a more volatile market. You may want to push back to a 10 delta or do a smaller size or things like that. So you definitely don't want to do this strategy in a bear market.
Sure. Do you, one final question, I don't want to dominate here.
Yeah.
Do you have a metric for your overall expectancy? Do you know what those numbers are?
Yeah, I mean, I bet, our assignment on these are very low. I probably get assigned maybe 10% of the time.
Right. Well, by expectancy, it's percentage per trade, which you generally know going into it for what you're risking. So I was just curious what you're generating in terms of your overall expectancy.
Yeah. Well, and keep in mind, I do them as spread. So on a 20-point spread, I'm generally getting between 60 and 75 cents per contract.
Okay, great. No, it's great. As a point of reference, I'm a little over 50 cents, so I understand. So thank you.
Okay, good. And a lot of it just kind of comes down to how aggressive you want to be on your strike. And as I've kind of gone through this year, I've gotten less aggressive. So I'm pushing that down just because it's not worth it. You'd rather just kind of just churn your puts and make money and than to take the stock, tie up capital, and write calls against them.
Very good. Thank you.
And so, some things to think about and I hope you can read this because mine's pretty small, but when you're doing this trade, when you're managing the trade, do you want to take, exit the trade early? Like say, for example, you collected $2 for your put spread and that credit is now down to say 50 cents, 25 cents. Do you want to get out early at a predetermined profit percentage? That's kind of a personal decision. Do you always want to hold them through expiration? It's kind of like I put it on, I leave it on and see how it goes. Do you ever roll the trade? And I personally, on my spreads, I will roll them out if I can collect additional credit. And then if this trade moves against you, do you have kind of a predetermined exit level? Say, for example, if the stock moves deep, how far into your short put before you say, I don't want to take it beyond this level? Or do you say, I'll take it no matter what? And then do you ever, like on my put spread, if the trade moves against my position quickly, a lot of times my long put will actually show a nice profit. And what I'll do there in some cases is close that out for a profit, and then I'll have a naked put. So, that's just something you should think about as you're building your strategy. Lots of questions and, lots of different ways of doing it. So if you, go on YouTube and you type in the wheel strategy, you'll probably get 20 different versions of the wheel strategy. So what I would kind of suggest is kind of take some of these points and build something that you're comfortable with that fits your trading style. And then just key takeaways. The wheel is a great strategy to generate income. And two, there are multiple versions of this trading strategy. So, what I do is what I call the wheel, and what Eric does or Lee does can be completely different. And there's no right or wrong version. And what I try to do is I have my version and I'm looking to see how other people trade it. So if there's a way, you know, like, oh, that's a cool feature, then I'll add that into my strategy. And I think too, it's important to know the risks of the trade, because I think a lot of people that are new to trading kind of hear that this wheel strategy is kind of an instant, cash card that you can just collect every week without any risk. So you just have to know what the risk is. And what I would suggest is build a trading plan or trading rules based on your own style, because the way I do it may not fit how you want to do it. And then the other one is, you need to be prepared to manage this trade, because it's not a set it and forget it trade, or at least in my way of looking at it is. If you have a setup that you said, I set it up, it expires, or I take the shares, then that's fine. But most people want to keep an eye on, see how the stock is doing and see if they need to do any adjustments. So that is what I had for the wheel strategy. So any questions that I didn't already address?
One interesting twist I saw somebody else do on this is that they dollar cost average down on their CSP.
Mm-hmm.
So if they do get a sign, they might sell another one lower and another one lower.
Right. I've seen that. Yeah. So that's another strategy. I don't tend to want to do that usually, because if the stock dropped for a reason. So it's kind of like trying to mitigate your losses by buying more. And sometimes you can dollar cost average all the way down to the seller. But but there are people who do that. And I try to I'm a pretty conservative trader. Would you agree, Lee? And so I try to go as far out as I can so I can get a reasonable credit and then, generate the income without a lot of drama. So any other questions on the wheel strategy or the selling puts?
If you get assigned on this,
Mm-hmm.
where do you sell the covered call?
That's a great question. I generally sell it at the price I got assigned. So on that case where it was a 405, say maybe the stock got assigned at 405, but the stock's at 400. So I will sell the 405. And sometimes that doesn't work. If it drops too far, you just don't get any credit for selling that at the money call. So you have to be real careful and not be too aggressive in what calls you sell. But my goal is in this strategy is if I get the stock, I want to basically exit the trade as soon as possible.
Brian, is
Yep.
your ROI better on the call side or on the put side, do you think? And why?
Well, these are only on the put side. Usually my style is I'm just really trying to exit the trade at the assigned price. So I'm not trying to look to make a lot of money on selling the calls. So I can, I make probably most of the profit selling the put spreads before I get a sign. Did I answer that question with your question? I rarely kind of look at generating a lot of income from selling the calls. Anything you get is kind of a bonus. Okay. Any final
Why
questions?
is that? I mean, wouldn't it just be the same on the reverse side of it? You could just sell calls and sell calls until you get assigned, or
Well, you're already if you get the if you
or I mean,
sit,
until they get, yeah.
you can but what your call, you're tying up, particularly, you're tying up say $25,000 in trading capital, and you're maybe making a little bit more in dollars, but return on capital is a lot less.
Right. Okay. Thank you.
Yeah. So I'd rather release that capital back and sell more put spreads.
Hey, Ryan, how about using margin to buy those stocks and then having a similar return on capital as the naked puts when you think about just buying.
Yeah, I mean, I don't trade on margin, so I'm probably not the person to try to answer that question. But I mean, ultimately, your risk is the whole stock amount kind of thing. So if you're on margin, your rate of return would be probably similar, but I personally would rather just free up my capital and have most of it in cash and be generating income off the put spreads. Okay.
Hey, Brian, would you have any guidelines as far as the underlying on market cap or open interest?
Yeah, I mean, you want to make sure that, kind of all the same rules apply. You want to make sure that it definitely has enough open interest, minimum of 100 contracts. You want to have a narrow, bid-ask spread. You don't want to be trading these on thinly traded wide bid-ask things. So, you look at the same kind of group of, stocks. There's probably 20 to 25 stocks or ETFs that I use for this strategy. So I don't go and try to find new ones all the time, but most of the time I trade the same ones over and over again. So, and if, you guys are probably on the Facebook group page where I post them, a lot of the same ones, trade SPY all the time, trade the other index ETFs, and then the other big name, stocks that you wouldn't want to trade something you don't know or know about the stock.
Would you stay away from something like ARKK?
I would. I don't think that, Tesla, I was kidding Lee that every horror story about a stock involves Tesla. So I probably wouldn't do that. So you want to stay as, based on my kind of trading style, I would stick to more blue chip, kind of stocks.
Thank you, Brian.
Mm-hmm.
Yeah, I have a naked put in ARKG, so I don't know if that counts.
There you so,
It's right. It's teetering right at. I sold the 75 put, and I think it broke through 75, and now it's back above 76, 78 or something now. So I'm kind of just
that's the dilemma.
I sold farther out for that one.
Okay.
I think it was 30 days. So I still have, or no, it was actually 45 days.
Okay.
But my plan was to, take assignment if I get it, but I felt like at the time I thought that it would just rally and I was going to take profits sooner, kind of thing.
Mm-hmm. Mm-hmm.
So now that we're in, correction or pullback or whatever, it's flirting with my strike, but I have time. I still got 30 more days. So if I hold through the correction and, it gets back up and I can get back out for, 50% of the profit or whatever, I'll do that. But it is kind of,
yeah. I mean, I think too, yeah, I mean, I think the market, how the market is going will also answer that question, Patrick. I mean, if it's a bull market and everything's good, I think something like that would probably be okay. But if it's more of a, kind of a struggling market or a correction, you want to be, kind of really ratchet up your quality of your underlying. Okay. Any final questions on the?
Wait, sorry. When you do SPY, how wide were the spread? You were doing 10 strikes?
20 wide generally. Mm-hmm.
Gotcha.
Yeah, and I generally will get somewhere between 60 to $1 for that spread.
Right.
Okay. Well, I hope that helped explain the strategy and maybe at least got you thinking of how you might want to build that into your trading strategy. And at the end, I'm leaving my email address. So if you do have any questions after the fact, please feel free to send me an email. I'll be happy to answer any, specific questions that you do have. And then the request was to cover the poor man's covered call. And really what the poor man's covered call, it's a long diagonal debit spread. And it's used to replicate a covered call position. And the strategy gets its name really because it costs less to get into the trade and there's reduced risk. And it's a bullish strategy. So you definitely don't want to be putting this strategy if you don't have a bullish thesis on the underlying stock or even the market in general. And sometimes I don't really like the term poor man's covered call because one, it's really not a totally inexpensive trade to put on. And two, it's just, I think a better name is kind of a leveraged covered call. So, but it's quicker than saying diagonal debit spread or diagonal calendar, that kind of thing. But so that's what it is. We're actually trying to replicate a covered call without buying the stock. So the basics, again, we're trying to replicate a covered call instead of doing a covered call. So we start with buying a long expiry call. And that's going to be our substitute for buying shares of stock. So, and I've read a lot of stuff on different strategies on how you might want to select this call. And a lot of people kind of comes down to you either want to go deep in the money or you want to be highly leveraged. So somewhere between a 30 and an 80 delta is what you want to be using for your long call. And the trade provides leverage because it costs a lot. And I'll show you in just a minute how much less it costs. So then once you've bought your long call or your stock substitute, then you actually sell calls against that until you just either hit your profit target or run out of time. And again, it's a bullish strategy. And the short calls, what they really do is they will reduce the basis in your trade. So whatever you paid for the stock, every time you write a call against it, you're reducing the basis in that long call. And these are usually longer term trades. You're going to be in this trade somewhere from a few weeks to several months. So it's not one of those trades that if you said, oh, I think it's going to go up in a week and I want to get out, it's probably not the best strategy for that. But if you think over time it's going to go up, this is a great strategy. And it's almost like not a boring strategy, but it's just one you just have to keep kind of selling the calls and monitoring your cost. And then, so the trade setup. The first thing you want to be looking at is, what stock or ETF do you want to trade? And personally, I've kind of evolved it. I only sell ETFs on this strategy. An individual stock, you got to deal with earnings at least every 3 months. So I used to do stocks right after earnings and sell the poor man's covered call, but I'd rather just have more time. So even if you do it a day after earnings, you're limited to 90 days. You've got to theoretically be out of the trade before another earnings event. So in terms of selecting the long call, what I do, I'm looking out between 60 days, and that's a really short period, up to 180 days. So I try to get in that 120 to 150 range in terms of buying that call. And then you want to decide, what delta strike do you want to buy? And one of the things that I always do, I'll look for a certain delta range, but then I'm looking to see, you know, what's a strike that's in that range that makes sense. Like, for example, if I might be choosing, you know, between, you know, I look for a even number like a 100 or a 105 or an 85. You want a big number. You don't really want a like a 87.5 call or something like, or a 92 call. You want to try to call, you know, select something that's, you know, has enough open interest. And what you'll see is a lot of times there's a lot of option strikes, but a lot of them don't have a lot of open interest. And yes, someone had asked, will we be sharing the PowerPoint? Yes, I'll definitely be sharing the PowerPoint with everybody. So we're going to go out, you know, I generally start at about 120 to 150 days. And then I look for what strikes have the most, have the most open interest, and then I focus on that. And now your lower delta strikes, they cost the least and they provide the most leverage. And then your higher delta strike, you know, they cost more, they have less leverage, but it's going to move a lot closer to how the stock moves. I know last month, Eric, you did a presentation on delta, and you know, a stock is a 100 delta. So if you go in and you buy the 80 delta, it's going to function pretty much exactly like the stock, but it's going to cost you more money. If you want to do a 30 delta, it's going to act a lot less, it's going to move a lot less than the stock price, but you have a lot more leverage. So it's really just a personal preference there. I try to look at about the 40 to 50 delta personally. That's where I find you get the most. It kind of, the price is good, you know, and the returns are good. So any questions about that so far? Okay. So here's just a quick example of the delta. So I went in today to get as current as I could, and I looked at XLE. So this is, you know, you hear a lot of people saying that energy is kind of an in favor sector. That was at least until today. And so the ETF, XLE ETF, was trading for about $53.46 a share. So if we bought 100 shares of this to sell covered calls, it would cost us $5,300. And that would tie up our money. However, if we went out to September of this year, which is really only 4 months away, we could sell the 30 delta, which was a 60 call, and that would cost us $1.60. And a 46 delta was the 55 call, that would cost $3.20, $320. Or you could go in and be, you know, as close to kind of the stock and buy the 80 delta, and it would cost you $950 per contract. So really, even the 80 delta is 1/5 the cost of buying 100 shares. And the buying power reduction here, I went back and I sold a call against it, the same call, and I'll show you in a minute. But you can see that the buying power reduction based on this is really not a ton of difference. The 30 delta was actually lower than the 80 delta for some reason. I've always found that kind of to be the lower the delta, the higher the buying power reduction. So as you're putting these trades on, you want to look and see at your broker to see how much money they're holding aside to put this trade on. Because it'll vary a little bit. And but you can see here, just, you know, the close to the, you know, 45 delta really only cost you $320 to trade covered calls against the XLE. So that's why a lot of people like the strategy. And so when you get up to the SPY, it takes a lot more, costs more to get that. But there's a lot of really good ETFs that you can trade the poor man on and make a great return. Any questions about choosing the delta? Anybody do the this strategy and use a particular delta?
I mean, I'm more personally interested in the data.
Okay.
I want my long option to have really low theta relative to my short option.
Okay. So, okay.
Hey, Brian, can you go back to that? And I just want to make sure I understand the relationship when you buy the Delta 30 call, for example,
Right.
for $1.60.
Right.
Why is the buying power reduction $13.50?
It's and I kind of had that question too. It's the way the broker, or at least Tastyworks, calculates what is the max loss that could happen if you sold a call against it and it blew through that call number. So
that, I'm sorry, that buying power is
this buying power based on selling a call against it.
Okay, that's inclusive of the okay, just
yeah. I kind of skipped that. I just wanted to include like what both pieces were.
Right. Interesting. Okay.
Yeah, and a question that come in on how far out do I sell the calls? I'm generally selling them about try to sell them weekly. So if I put a call on to, if I bought the long call today, I'd probably be selling next Friday's expiration. But that could be, that's kind of just my style of trading. You could sell monthlies against it if you wanted to, things like that. Okay. And okay, so selling the short call. I recommend selling the weekly calls against your long call because you're able really to generate a lot of income and really reduce that your basis in the stock. I actually had a gold trade, GLD, where I sold enough calls where I had totally eliminated my basis in the long call, which with about 3 months to go. So that was almost like a risk-free trade. So you can do that if you sell a lot of calls against it. And going back to what strike you sell, you want to make sure that you're selecting that shorts call based on some plan. So you could either use a delta, say I'm going to sell between the 10 and the 20 delta every week. I want it to be above the resistance level and beyond the expected move of the stock. So, so you can kind of set it up that way. When I first started, I just sold the 10 delta, and I always felt like most of the time it didn't even come close. So, but I'll look at that. I'll choose the delta. I look at the resistance level and the expected move of the stock. So you're selling these, and again, you can sell weeklies, you can sell them every 2 weeks, or whatever you feel comfortable with. And then you got to make sure when you're monitoring this is that you want to make sure that the stock or the ETF stays below that short strike, because unlike a covered call, you're not going to get assigned 100. They're not going to take away your shares of that, because all you have is basically 2 separate trades. You have a long call and you're selling a short call. So you want to make sure that you're like, oh, they'll just take away my long call. No, they'll just assign you the shares. So you want to make sure that you really don't sell a strike that's too close, and then you have to roll it. So and then a lot of times what I'll find is I'll sell the call, and maybe I'll get $45 for that call, and by Wednesday or Thursday, it's worth $2. So that's when I would take it and roll it out to the next week. I don't generally let them expire, because by the time at the end of the week, there's almost no value by the end, with like 2 or 3 days left in the week. And when the short call does get challenged, and it'll get challenged, that you want to keep rolling that out and up and taking additional credit. So that's how I do the strategy. Any questions?
Brian, what if you can't roll for a credit?
If you can't roll for a credit, that generally means that your long call is pretty profitable. So at that point, I look to close the trade. Because remember, if you're buying that long call and the stock price moves up to your short strike, say it was a 10 delta, then you've had a pretty nice, movement on the stock. So you're making, if you chose a 40 delta, for example, and the stock moved, 10 points, the price of your long call will have gone up about $4.
Right.
So,
And then you look to stay out of that ticker, which you feel has gone too high, too fast, and look for something much lower.
yeah, what I generally do is if I look at, the IWM, the SPY, the Qs, if I see one of them drop like 2% in a day or in a couple days, and I think that it's just basically a market shift kind of thing, that's when I would put the trade on. So I'm usually looking for some kind of a pullback. This is probably your ultimate buy the dip strategy.
Ryan, do you find that the bid-ask spread is high on some of those long calls?
Yeah, I mean, that's one problem, is that you do have a wider bid-ask spread. So, especially I think if you go further, like down to the 30 delta or something like that. So you want to look for the strikes that have the most open interest and the shortest and the smallest bid-ask spread. But yeah, you'll see that sometimes. And sometimes that's a reason, like sometimes you'll see people that talk about the strategy. They say you should go out 365 days. And you'll see that is even a bigger problem, with a big bid-ask spread. But you can find ETFs, index ETFs, or sector ETFs that don't have a super wide bid-ask spread.
Hey, Brian, is there any kind of relationship between the delta of the long call versus the short call? Because I'm just thinking, I've always kind of leaned toward, I haven't really done this that much, but I've always just kind of been taught or read about buying like an in the money call and selling out of the money calls. But if you're buying a delta, let's say 50 call, and selling a delta 20,
right? But
then at some point, let's say the stock starts to move lower, can you sell the call, but that's actually below does it have any relationship with the strike you're in versus?
No, I think the only relationship is that the broker may take more money and set it aside on the trade. But I've traded it both ways. So at the exact same strike, lower strikes, it doesn't matter. Because really it's two different kinds of trades.
Two trades, but it's basically your long call's hedging your short.
Yeah, you're in.
Okay, so you could buy a delta 30 call and sell something below it.
You could.
Shorter duration.
Mm-hmm. Yep. And as a matter of fact, I think when Art did a presentation sometime last year, he recommended selling the lower, like a 30 delta. So, so I've kind of found that probably that 40 to 50 delta is kind of my sweet spot.
That that you buy,
that I buy, right?
and then you sell something like a 10 or
10, 15, maybe, yeah.
right? Okay. Thanks.
Because I think where I've run into trouble is if I got aggressive and I sold a 20 delta and the stock blows past that number, then you're adjusting the trade and you might have to get out early. So I would prefer to, sell that 10 delta, collect it a few times, reduce the basis down. Then you're in a position, where you can sell it for a nice profit.
Right.
And I know I'm running a little bit over, so I'll hurry up. The managing the trade, I generally try to exit for about 50 to 75% profit on these trades. So just as a quick example, if you paid $10 for your long call, so you've paid $1,000 and you've collected $4 in credit, $400. Now your basis in the stock is $6. So if you're able to sell that long call for $10, then you're making, a $400 profit against a reduced basis. So you're making like a 66% return. So they do generate a lot of, a great return, especially I think if you can buy them on a dip and then you can ride them back up to the previous level.
Can I ask a question about that?
Sure.
Why wouldn't you consider the credit taken in as return and keep your original cost basis the same? So say you paid $10, it's still $10, but now you have $400 of profit plus.
Yeah, and you can do it that way. It is $400 of profit, but when to me, it's harder to track your results. If every week you're collecting, 50 cents, $50, and then over an 8-week period, now you've collected $400. How do you kind of combine, kind of show what your actual return on that entire trade was? So it's the same $400. So you could do it that way. There's no right or wrong answer. I just like to track how much credit I took in and what did the entire trade make? Okay.
And I just ask because the percentages are different. If you do 1,400 over 1,000 versus, some 400 over 600, I think.
Okay.
So you got 40% versus 66%. The 66% sounds a lot better, but I used to count it against, especially when if you sell enough to get close to zero, like you said on the GLD trade,
right?
Then your ROI is astronomical.
Yeah, and I to tell you the truth, I never even thought about doing it that way. So it's just the way I kind of learned it and kind of followed it that way. But there's nothing wrong with doing it the other way.
Okay. Thanks.
I just think it would be a lot harder to track it. Sorry, someone was going in.
Yeah, Brian, have you played with, because this is something I've done before, but they call it juicing the income by selling an additional call credit spread on top of the short call. So it's effectively like a ratio spread that's on top of the long call.
I've heard of that and I've seen it. I personally haven't done that, but I mean, it's you definitely could do that.
Yeah, because your credit could be increased, like in your example of $4, that could be $6. Usually it's something, maybe like a 50% increase in income.
So you're selling a call spread on top of that.
Yeah. At the same delta.
Same delta. Yeah. I mean, I think that's a great idea.
The risk is if the stock soars, you're not going to capitalize on the stock movement.
Then you're gonna have because it's technically more of that's a bearish trade. So you could get in trouble. But if you're picking, something like a 10 delta, it might work.
I mean, it's the same trade though, right? You're buying a call and selling a call. So that's why I was asking about like if you're buying a call and then selling one lower.
Yeah, but it's a different time frame, different expiration.
Okay, that's right. It's a different time frame.
Yeah, but the idea of selling another call spread on top of that definitely would juice your returns. And like someone else mentioned, if it blows through there, then you got a problem because that's technically a bearish trade.
Yeah, it doesn't really work that way. You still actually gain more from the long call because if it blows through, yeah, you lose on the call credit spread, but
Right.
many weeks of the extra income
Yeah.
usually outweighs it.
Yeah, I like the idea. I'm going to have to think about that. That's good.
Yeah. Tasty Works calls it juiced income. I think it's their
Okay.
term for it.
Okay, that's interesting.
To get
Thanks
that
for-
in the risk
Or
profile.
juicy calls. Juicy calls.
Juicy call. Okay. Oh, thanks for sharing that. And then, when to enter the trade. So I generally wait for some kind of a pullback. If there's, it's the index, XLV, XLE, or the SPY, if there's a pullback of, 2%, and I think it's just a temporary thing, that's to me is the perfect time to enter this trade. Some people wait for, a second test of the lows. It hits a low, it moves up, they wait for it to come back. That's when they want to enter it. Or the other thing is if, you see a particular sector that has now become kind of in favor, and you think, over the next 3 to 6 months, this ETF could really kind of, appreciate in value. This is a good way to kind of take advantage of that on a leveraged basis. And then I've done this before, but with mixed results on stocks. Say you have a really good stock, and particularly if it has good earnings and it still pulls back, that's when I might try to do it on an individual name stock. But like I said, I've had mixed results on that. So I personally just stick to ETFs. And takeaways, again, it's an excellent bullish strategy. It's a leveraged trade, so you have a lot less capital requirements. There's multiple variations like we've heard today. I've learned about juicing the credit, which I love. You can do it I recommend trading it more on ETFs. You don't have to worry about earnings events and things like that. So you just tend to, hold them a little bit longer if you need to. And it's important to kind of track the credits as profit as you do them, or reduce the basis and calculate the entire trade, which is pretty much the same, just a different way of doing it. And again, these trades can take, you can be out of this trade in a few weeks, or it could take a few months. So, but it's probably not one that you're going to enter on Monday and be out on Friday. So just wanted you be aware that it's not a short-term trade. And let's see what else. Okay, after the buying on the dip makes, I think, improves your chances of profitability. So anyway, and now I have any other questions that I didn't answer for you guys? You had a lot of great questions.
Brian, so we talked about the wheel and poor man covered call. I've thought of, is there an interesting way we can actually merge the two, where I love the poor man covered call, but I don't like to get in until there's a dip, and selling puts is a great way for myself to, to discipline myself.
Right.
So how can we sell puts, and then when we get in, we actually do the poor man covered call, like sort of merging the two?
Yeah, I mean, I think that's a great idea or thought, but I think when you sell the wheel, you're selling puts, and what the result is, you're going to get the shares of stock versus the poor man, where you're actually saying, I'm basically doing a substitute of buying the shares. So
does it make sense to unload the shares and then buy the call instead, or that's just actually just generating a loss because you're selling the shares lower than when you're assigned?
Yeah, what you could do is, if you were doing the wheel strategy, say you were, pick an ETF, say you're doing it on IWM, and it reaches, your short put level. What you could also, and you took the shares, you could at the same time buy, create a poor man's covered call.
Yeah,
because you got your, that's your dip basically. And that's how I would see how you could kind of build that out.
Yeah.
Interesting though.
Okay.
Any other questions? You guys have been great. I always love it when people ask good questions because I don't have to just stare at my screen.
Just one comment on that concept of the juice trade.
Mhm.
If you were really bullish on the stock, why would you sell a call spread as opposed to a put spread?
I guess it's probably just a matter of how bullish you are. I mean, if you're bullish on the stock, but you're selling a 10 delta, your probability of getting up to that 10 delta is pretty small. And again, I don't trade that, but I think it's an interesting idea.
Thank you very much.
Sure. And then some people asked about our Facebook group page. I have a Facebook page that's called the Conservative Covered Calls Facebook group. And I post trades in there. I do the wheel strategy. I do a trade where we capture dividends. Maybe we could talk about that sometime. And I do some in the money covered calls. But you're welcome to join the Conservative Covered Calls Facebook group page. And I also have started putting some of my trades in Eric's group. And I just got to be a little bit more diligent to put them in there. You know, your Mighty Networks trading group. So, but if you do have any other questions, you know, don't hesitate to shoot me an email, and I'll get the PowerPoint slides up. And as soon as we get the recording kind of done, I'll get that out so we can you can see it again, or if you missed it. So I'm going to stop the recording.